Good morning. You're listening to Insurance Matchmaking, your path to health, life, and Medicare coverage with Matt Libby Insurance. And now, sharing his knowledge, here's your host, Matt Libby.
All right, welcome back to Insurance Matchmaking, and I apologize right now. I may stop and cough. Voice may be a little scratchy. I was really down this weekend with a cold. Still have some of the sinus irritation, a little coughing, a little sneezing, but hopefully we can get through this okay. And needed to get in here. I actually came in on a different day than I normally record. I've just got a lot of things coming up and a lot of different meetings on Wednesdays this month and this recently. So had one show in the bag last week, so was able to skip the recording last week, and I can't remember now what I did last Wednesday, but I wasn't going to be able to be here. And then this week I've got something to do in Nashville because we are coming, as I've mentioned in the most recent shows, we are coming up on enrollment season, and so I have an event with a carrier in Nashville on Wednesday morning. So anyhow, speaking of enrollments, been kind of beating this dead horse also, but a lot of changes with the in some ways they're not changes, they're going back to what they were, but and again this is not part of the one big beautiful bill, other than they could have included some of the changes in that bill because the expanded tax credits are set to expire on December 31st. So everybody has the expanded tax credits. Some of that's going to change for some folks, but that was not because of the one big beautiful bill. I had a client call me yesterday and was concerned about, because heard that the special less than 150% special enrollment opportunity was going to go away, which shouldn't be a concern for her because she is on a plan now. That is just a special enrollment for people who don't have a plan but are lower income, but they still qualify for tax credit, as I've mentioned many times, that to qualify for the affordable care tax credit, which can make the plans affordable, because generally they are not affordable if you're not getting the tax credit. You have to earn at least 100% of the poverty level, and above. So, and those people get the maximum credits. They get the cost sharing reduction on the silver plan, so they get a lot of extra benefits there and can have some good, very, very good affordable insurance for them because they're getting assistance. You have to maintain your income. That's one of the things they have kind of cracked down on. People had not been filing their income tax, or they hadn't been updating their enrollment, so they're being a little stricter on that. And then there was also, you could still earn up to 150% of that poverty level and have a ongoing special enrollment throughout the year. That is ending on August 25th. Now that, again, does not apply to anybody that's on a plan now. There's no change for anybody on their marketplace plans from now until December 31st, other than some of the people who had not filed their income tax. They're finding some of those that, wait a minute, you haven't filed your income tax in 2 years. Prove that you filed your income tax, or at the end of this month, you're losing your tax credit. So I've had a few people call on that, and I put that out on a recent show to go ahead and make sure that you, if you haven't filed your income tax, and especially, it's good for advice for anybody. If you haven't filed your income tax in a couple of years, you probably need to do something there just to make sure you're not in trouble. But if you're getting assistance on your health care through the health care marketplace, it is very important that you file your income tax and file it every year to ensure that you're getting your tax credits. So I wanted to get into that because one of the things that's affecting those advanced tax credits, and it's not going to be so much what I'm talking about today, is not on the lower income. It's those that are on the higher income. So previous to the expanded tax credits, you were only eligible for tax credits if you earn between 100 and 400% of the tax credit. So when that occurred, most of the clients that I had that it was affecting were generally in their upper 50s, early 60s, not eligible for Medicare yet, empty nesters, usually a couple, every once in a while you have a couple that still has a dependent, or maybe one spouse is younger, so they have a younger child that's still a dependent, or a lot of times I've run into ones that they qualify because that dependent is a grandchild they're raising. So some of those people would qualify for that, be under the 400%, but when that grandchild, maybe they're 18 to 23 or 20, and now they're working and on their own, and they're not claiming them as a dependent anymore. Now it's not their income spiked, but their percent of the poverty level would spike because they're now a tax household of 2 and not of 3. So those were the issues I'd run into. So some of the issues I would run into with people that were close to that 400% and then weren't going to be available for a tax credit. And I've noticed somebody that I follow on YouTube uses the phrasing that I also use, and it's the tax credit cliff. Because what would happen is you've got this couple, say they're both 62, and their income was right at about just under $70,000. Well, they would get about a $1,800 tax credit to cover their bill. They could possibly get a zero premium on a bronze plan. If they went to a silver plan, they maybe were paying $100. So it was very affordable. They had the lower deductible on that silver. But when they filed their income tax, they had misestimated. They earned $75,000. I mean, of course, this is all hypothetical. So this is all hypothetical that what their income actually was, but if they went over, and I'm using round numbers, I think it was about $69,000 a few years back before they did the expansion, but say $70,000 was the cutoff for their household to be over 400%, and when they filed their income tax, they actually earned $75,000. They're no longer eligible for the tax credit they received. Remember, I said they were getting $1,600 to $1,800 a month to pay their monthly premium, and then when they filed taxes, and you weren't entitled to $1,600 a month. You weren't entitled to any. You have to pay that all back because it's an advanced tax credit. So that's what a lot of people don't understand. I try to make sure that all my clients understand that, especially if they're close to that income amount. So that is something to be aware of. But the good news is, and I guess I know I've kind of been really kind of going Debbie Downer here, but I meant to announce I have some good news. The good news is the 3-year short-term plans are back. And I talked about those before and said I thought they would probably be in the early part of the year, at least by, early summer. And I've mentioned about recently there's still a lawsuit going on. So, but it was determined that until they finish the lawsuit, to go back to what the rules were before the injunction was put in on the not being able to do those plans. So we've been writing short-term plans, and you can only go 4 months with one company. So I had one source that actually would cobble together 2 different companies, and so we do 4 months with this plan, 4 months with that plan, and then 4 months with another. And so we could still do 12 months of coverage there. But most of the plans were, hey, if you write a 4-month plan, you couldn't immediately renew that plan into another 4-month plan. You had to go to another carrier. Fortunately, I only had one client that I had to do that with. We've been playing that game of going to this plan and then going to that plan. Well, now we're going to be able to set up a 3-year plan again. And the way that works is the short-term plans are medically underwritten. You do have to qualify health-wise to get a short-term plan. They were designed, of course, that's why they call them short-term plans. They were designed when you go between, say, having insurance at your employer and you're going to move to another employer. And so you would go ahead and get a short-term plan so you'd have continuous coverage, because that was the big thing before the Affordable Care Act, was if you didn't have continuous coverage, they'd turn you down for health reasons. But as long as you maintain continuous coverage, you could still have insurance. So people would get the short-term plans when they leave an employer plan, and then when the next employer plan came up, they drop the short-term plan and take the plan with the employer. Well, the Affordable Care Act kind of cut away that need, but then they found out that, well, gosh, I don't qualify for a tax credit. This Affordable Care Act is not very affordable. So you could get a short-term plan, and to be a short-term plan, they cannot be more than 364 days because they can't go for a full year. So there's some plans are 360 days, some are 364, and then you have to go through the whole application process again, go through the underwriting again, and if something changed in the year while you had that plan, then you couldn't renew the plan because you can't Now you can't pass the underwrite. Now, they wouldn't cancel you if something happened in the middle of the year and then you lost your coverage, but they wouldn't renew it. So now, and depending on when you got that short-term plan, if it's in the middle of the year, you may have to wait till the next open enrollment to get insurance again. So you'd have that gap. So one of the things that the insurance companies did was they had started with these 3 one-year plan deals. One company calls it the tri-term, but not everybody uses that term, so I'm not going to. But you apply once for 3 years of coverage. Now, the beauty of that 3 years of coverage is you can still cancel that coverage at any time. You're not committed that I have to keep this plan for 3 years. It's all to your benefit. They can't turn you down as long as you are paying your premium. So if you pay the premium and it comes up renewal. Now you will have you have an increase. I've got one company that you can pay a little more up front and lock in your rate for 3 years. Most of them, though, they're going to reevaluate at the 3-year mark and say, okay, this is what our rates are. Of course, you're a year older, so each year when it comes time to renew, then your rate goes up. But it's considerably less than what the healthcare marketplace plans cost. So we're coming up on the break here. I'm going to go a little bit more into this, but I wanted to share that good news, and then I'll recap that after the break.
Join Habitat Restore at their pop-up donation event every second Saturday of each month at First National Bank in Sparta. The Habitat team will be there ready to go to receive your donations. So don't miss an opportunity to declutter and make a difference at First National Bank in Sparta with the Habitat Restore pop-up donation event every second Saturday of the month.
It's back to school time, and Twin Lakes Fiber Internet gets an A+ for keeping everyone happy online. Kids doing homework, mom watching her favorite show, dad glued to the game. Rest easy knowing your internet can handle it all with a gig speed fiber connection. Now with new speeds and lower prices, there's never been a better time to make the switch. Call 800-644-8582 or visit twinlakes.net to get started today.
And now, back to Insurance Matchmaking with Matt Libby Insurance.
All right, welcome back after the break there to Insurance Matchmaking. I was talking before the break about how the 3-year short terms are back. If you're just tuning in, what the companies do that offer the short-term medical plans that are medically underwritten, they offer you the opportunity to buy or enroll one time and have 3 years of coverage. And as I was saying before the break, you're not locked into that 3 years. If something changes and it makes sense for you to go to the healthcare marketplace, or you or your spouse changes jobs and now you have employer coverage, it might be a little better coverage or a little bit more affordable than paying full price for the short-term plan, you can switch. Now, I also have mentioned that I also have started offering the MediShare plans. And so that's going to be some opportunity for folks to be able to get insurance for a lot less than what you'd pay. I called it insurance. It's healthcare. You can get healthcare coverage through a membership plan through the MediShare. It is not insurance. I have to make sure to remember to say that. It works very much like insurance, but there are some unique differences that's something to go over one-on-one, but that's something that might interest you. But I bring that up because that's one of the other options we go to. That was a great option for folks when there was the tax penalty for not having insurance. And a lot of people still think that's an issue. That was changed back during the previous Trump administration as part of the tax bill that eliminated the penalty that if you didn't apply through the healthcare marketplace or had a qualified health plan like through your employer, you would have a tax penalty. So the good news is there is no tax penalty if you don't get insurance through the healthcare marketplace. If you don't have another source of insurance, you don't have insurance. So that's we don't want that to happen. So MediShare is one option. No, I was saying one of the reasons why people went to MediShare was it qualifies as a qualified health plan. They were kind of grandfathered in, as they say. So that was a good option for folks that didn't qualify for the tax credit, or they just had personal reasons why they wanted to get their insurance through that because of some of the things that the MediShare won't pay for, and the insurance company will, and some people had religious opposition to the health plans that are offered to them, so that was an alternative for them. So a lot of people would do those health sharing plans. A lot of times what happened was, say, a small church, the church would maybe pay for their pastor and the pastor's family to have coverage, but they didn't have enough employees to have an employer group plan. So a lot of times that's what would happen. Missionaries, things like that, were a lot of people that would do the MediShare. Anyway, those are not as expensive as a marketplace plan if you're not getting the tax credit. So if you possibly can get the tax credit, it makes sense still to go with the marketplace, but we can look at those different options. The other option is, as I mentioned, was short-term plans. And one of the reasons for the short-term plans, if you use tobacco, you can't do MediShare. That's one of their restrictions. Short-term plans do not have that restriction, but they will charge you more if you're a smoker. And it depends on the plan. Tobacco use, or definitely cigarette smokers, you're going to pay a higher premium. So you have that higher premium if you're a smoker and you're not eligible for MediShare. The other thing is the short-term plans and also the MediShare coverage, they don't have usually don't have anything for preventive care. You're going to, if you're going to get that prostate exam, or you're just doing that annual wellness check or mammogram, for the ladies, those generally aren't covered on these other plans that do have to cover on a qualified health plan like group plan or marketplace. So the group that I work with to offer MediShare also has a plan, and it's called Wellness Share, and it can work with the short-term plan too. And it has 3 levels. I think I talked about it a few weeks ago. But there's 3 levels to this plan, and the one is basically just preventative and prescription discounts. So you pay so much, it's guaranteed issue. It doesn't ask any health questions. Actually, doesn't ask the smoker question. Doesn't ask height and weight. It's just like name, date of birth, and then we probably have to have social security number. But it's a very quick, easy application. Fill it out, put your name and your payment information in. It's issued. Now, there is one drawback to it, that it does start on the first day of the month of the following month, but it's not like most insurance plans that as long as you apply by the last day of the previous month, it goes in effect. This one here, you have to get it before the 25th of the month. Otherwise, it is going to be another month down the road before you can get it. So we're out getting close to the end of the month. If that's something you think you might want and want it in place by September, you have to do it by August 25th. But if we're looking at just replacing, an open enrollment plan, we can do that. We've got time to get that put in place. I bring those plans up. The 2 other levels will cover reimbursements for things like surgeries, doctor visits, and the one I mentioned, I don't have the sheet in front of me now, but it's very little. The price for a family for the top level is so little above the second level, it doesn't make sense as a family to take the second level. But it has accidental death and dismemberment plan built into it, and also pay so much for hospital. So one of the examples I use is the top level on a MediShare plan has a $12,000 annual portion. So that means if something happens, you go in the hospital, you have your medical care, you're going to pay the first $12,000, and then after that, your expenses are shared, so that you're not going to have to spend more than $12,000 on your health care, and that's only if you have some catastrophic events. So on this Wellness Share plan, it has $10,000 for hospitalization. So what would happen is if you were hospitalized, you're in the hospital for several days, and you get a bill, and it's over $12,000. You're going to have to pay the bill, or at least get the bill and have it. You can start making payments on it. You don't have to pay it off. In this process, I'm saying, you still have to pay it, but let me go through the details here. So say you have a $15,000 hospital. We'll keep some round numbers here. So you're going to submit that bill to Wellness Share, and you'll get that check for $10,000 for your hospitalization. And then for the MediShare, you still have $2,000 of your annual household portion. So you pay that $2,000. So, and then there's still $15,000, but there's $3,000 then now will be shared of that $15,000. So out of that $15,000 bill, you had to come up with $2,000 of it, in theoretically. You may have to pay the $12,000 and then get reimbursed the $10,000, but after you've paid the other $2,000 to get to $12,000, now your sharing program is sharing the rest of that. Short-term plans work somewhat similar. They're going to have a deductible, whether it's $10,000. There's one that has a $25,000 deductible. That may or may not be the best option, but there are other things that we can put in place that will pay for the catastrophic things. And that's why I try to encourage a lot of my clients to go for that option, is just going year to year, you're not going to hit that max out of pocket. That's one of the things I like about this wellness share plan, that even if you just take the lowest one and it covers your preventive checks, you're not going to pay anything for those preventive checks. You're just going to pay that monthly fee. And like I said, I didn't bring the sheet, so I don't have the amounts in front of me. Get a hold of me and we'll take a look at and see. And it's one price for everybody. It's like they ask your age, but it's the same rate. If you're an adult, you're an adult. That's the rate. Now that rate, I guess, could possibly go up year over year. I mean, they're not raising the rates right now, but they could, reevaluate, a couple of years from now and say, oh, these are the rates now. Now, whether they'll raise that on someone who already has the plan, I don't know. I'm new to this company, so I'm not sure if they did raise the rates, if they raise it on everybody or just raise it on new people. That's the way I've always thought they should do with these plans, but I know I've had some people with dental plans that they raise the rates and they don't just raise it on new people, they raise it on everybody that has it, which, makes sense in one way, but just seems, a slap in the face. You said this was my rate, and then you raised it. But the wellness share, I think, is a great option. I have other, like short-term plans that will cover for accidents, or if you get a critical illness, or you have a heart attack, you get cancer, that will pay out. And again, that deductible is not going to be an issue. If you have a $50,000 cancer plan and you have a $25,000 deductible health plan, and you get diagnosed with lung cancer or breast cancer, colon cancer, and you get that check for $50,000, well, you've got enough now to cover your deductible for 2 years. So, that $25,000 deductible isn't a big issue at that point, because you've got something else in place that will cover it. And the reason I bring that up is getting these supplemental coverages will cover that deductible, but you also have those in place for when you get other insurance. Maybe my example, most people I'm working with on the short terms are people that are in their 60s. They're going to be on Medicare in a couple of years. And the thing is, the beauty of the cancer plans, once you buy that plan, you set that rate. It's not going to go up when you have a birthday. If you got it at when you were 60, when you're 70, it's still going to be the same premium. They're still going to pay the same amount. That, hey, if you got cancer for $50,000 worth of cancer, they're going to pay you the $50,000 or $20,000 or $50,000 or $15,000, whatever amount you pick. You're not worrying about that big deductible anymore, but you're still going to have other expenses come up. So you kind of do both, is save on that monthly premium on your health plan, that you only go to the doctor a couple times a year. You're never going to meet your deductible. You just have to pay for the doctor, or you have your preventive. And so you're paying, or if you have that preventive plan, you're not going to pay for those preventives. You might drop that after you go on Medicare, because now all your prevent is covered through Medicare, but you still may want something in place for hospitalization or cancer coverage, something like that. So there are plans that we can help you protect against in the long run. And one of the things, and I've kind of probably don't have enough time to go into it, but one of the things I think it's kind of like with car insurance is, we got an older car. We're not going to pay extra for that full coverage, as they say. We're just going to get the liability, because we don't want to have to pay for somebody else's car if we run into them. So that's the way I kind of look at the high deductible on the health plan. Health insurance is the transfer of risk. We want somebody else to pay if something catastrophic happens, but we've gotten used to with healthcare that, our healthcare plan pays for everything. If you think of it, with car insurance or your homeowner's insurance, they don't pay for everything. They don't pay for your oil changes. They don't pay for you to paint your house. But tree falls on your roof, you're not going to have to come up with the full cost to replace your roof. Somebody T-bones you in the intersection, you're not going to have to pay for getting your car fixed. Or if you're the one who T-boned, you're not going to pay for the other person's car because you have the insurance. If we get people kind of thinking of their health insurance the same way, it's not there to pay for all your health care. It's there to pay in case something catastrophic happens. And that's why I will talk about higher deductible plans with supplemental coverage, because you're going to pay less for that supplemental coverage than to have pay a higher amount for a lower deductible. And again, most of the time you're not going to hit the deductible on those plans unless you're hospitalized. If you have a serious illness or injury. So that's why the high deductible with a supplemental plan is actually going to be more economical for you. So let's set a time down and let's go over your options and see if I can't help you protect your pocketbook for those unforeseen expenses. So until next week, keep listening and to Insurance Matchmaking. Remember, at Matt Libby Insurance, we can cover you from head to toe. It doesn't have to cost you an arm and a leg. And go to insurancematchmaking.com, listen to previous shows, and offer your suggestions for topics and guests. And talk to you next week.
You've been listening to Insurance Matchmaking with Matt Libby, your path to health, life, and Medicare coverage with Matt Libby Insurance.